Michael Burry, the investor who famously foresaw the 2008 financial collapse, has just taken another dramatic step that has the markets talking. On November 10, 2025, his hedge fund, Scion Asset Management, officially terminated its SEC registration, effectively closing its doors to outside investors. This isn't simply another fund shutdown. This is the same man who correctly identified the subprime mortgage crisis long before it devastated the global financial system, personally pocketing over $100 million while banks crumbled around him. Now, he is stepping away entirely from public investing, and his reasoning is striking. Back on October 27th, Burry informed his investors that his method of evaluating the true worth of securities is no longer aligned with market behavior, a divergence that, according to him, has existed for quite some time. To put it simply, the man who accurately predicted one of the largest financial disasters in modern history is now saying that the math no longer works. This is not just a casual observation. It is a warning signal about the state of the market itself. The story becomes even more intriguing when we examine Burry's most recent 13 degrees Fahrenheit filing for third quarter of 2025. It revealed that he held $912 million in put options against Palantir and $186 million against Nvidia. These are significant bets that these tech giants, particularly in AI, are set for a major downturn. What's more, these positions are not short-term gambles. They extend into 2026 and 2027, suggesting that Burry expects the market correction to be both severe and prolonged. Burry has also publicly criticized certain tech companies for allegedly manipulating depreciation schedules on their AI infrastructure to artificially boost earnings. This goes beyond typical market commentary. It is an outright accusation of systemic accounting irregularities across the technology sector. And when someone of Burry's credibility and track record raises these concerns, they cannot be dismissed lightly. Another unprecedented element of this move is Burry's shift to a family office structure. By doing so, he eliminates the requirement for public reporting, effectively disappearing from the view of outside investors just as the markets hit record highs. His final public statement on social media hinted at this transition, suggesting he's moving on to much better things. Notably, this is only the second time in his career that he has voluntarily closed his fund during a market uptrend. The first, of course, was in 2008, just before the housing market collapse. Back then, Burry made his legendary bet against subprime mortgages, defied skeptics, and saw his fund return a staggering 489% in 2007, earning him over $100 million personally. He then shut down Scion Asset Management while the financial system was still appearing stable, 6 months before Lehman Brothers collapsed and the global economy nearly imploded. The irony here is striking. Today, as the S&P 500 hovers near record highs and AI-driven tech stocks seem unstoppable, the man who accurately called the last major market crash is stepping away, saying that profitability in these markets has become nearly impossible. This is not a critique of his ability as an investor, it is a statement about the market itself. What we are witnessing is a master strategist walking away from the table, not because he is losing, but because he recognizes that the rules of the game have fundamentally shifted. History repeatedly demonstrates the significance of these actions. Legendary investors closing shop during market peaks is rarely coincidental. It is one of the most consistent early warnings of an impending crash. Consider Jesse Livermore in 1929, the era's most renowned trader. While the world celebrated the Roaring '20s, Livermore quietly exited his long positions and began shorting the market, seeing the disconnect between stock prices and actual earnings. His foresight allowed him to profit enormously. From the October 1929 crash, while millions of others lost everything, the pattern repeated again in March 2000 with Julian Robertson of Tiger Management. Having delivered decades of exceptional returns, Robertson closed his fund during the height of the dot-com mania, citing irrational valuation in the tech, internet, and telecom sectors. While the market initially mocked him, the Nasdaq peaked a month later and then collapsed by 78%, wiping out trillions in value and bankrupting companies that had been hyped as revolutionary. Robertson's warning had been accurate. he was simply ahead of the curve. Michael Burry's first major market warning followed the same trajectory. From 2005 to 2006, as housing prices soared and banks handed out subprime loans like candy, Burry quietly purchased credit default swaps on these risky mortgages. His investors doubted him, regulators dismissed him, and the broader financial establishment labeled him paranoid. Even his own clients attempted to withdraw their money. Yet Burry had done his homework. He had analyzed the loans, examined the underlying documents, and identified the systemic risk hidden within the housing market. By 2007, his fund returned 489%, and he personally earned over $100 million. 6 months before the financial collapse, he closed Scion Asset Management, leaving the rest of the market to face the consequences of the crisis unprepared. This pattern extends beyond individual investors. Figures like David Einhorn and Seth Klarman have similarly warned or returned capital in recognition of market dislocations, highlighting that when experienced investors cannot find value, it signals a fundamental disconnect between market prices and economic reality. Markets operate on two primary forces, fundamentals and momentum. When even the most skilled investors recognize that the numbers no longer make sense, it is not merely a personal decision, it is a red flag for the entire system. When market momentum completely overtakes fundamentals, even the most brilliant investors recognize that traditional analysis loses all relevance. At that point, they step away entirely. History has shown us this pattern repeatedly. Every major market crash begins with asset prices soaring far beyond any reasonable valuation. The smartest money quietly exits, selling into a frenzy of buying by less informed participants, while retail investors, driven by fear of missing out, continue to pour money in. Eventually, the divergence between price and true value becomes so extreme that even minor selling triggers a cascade of forced liquidations, amplifying the crash. Ordinary investors are almost always blindsided. They're the last to enter at the peak and the first to panic when the market turns. In 1929, Jesse Livermore sounded the alarm, but individual investors ignored him and lost everything. In 2000, Julian Robertson warned about the dot-com bubble, yet day traders mocked his caution and suffered massive losses. In 2008, Michael Burry predicted the housing collapse, but homeowners dismissed him and lost their homes. The script is eerily similar this time around. Michael Burry is once again closing his fund, echoing the same language and rationale he used during previous market bubbles. The only difference now is the sector driving the mania. In 2007, housing prices were the bubble. In 2025, artificial intelligence and related technology stocks are at the center, yet the underlying dynamics are identical. Easy money injected into the system creates artificial demand, valuations spiral out of sync with reality, and shrewd investors recognize the mathematical impossibility and exit the market. What follows is almost always catastrophic for those who fail to see the pattern in time. Burry's massive bearish positions underscore just how serious he is. His $912 million wager against Palantir isn't a short-term speculation. It's a direct challenge to the inflated AI bubble. Palantir currently trades at over 300 times earnings, far above the historical market average of 15 to 20. To put that in perspective, investors are effectively paying $300 for every $1 of annual profit the company generates. At that rate, it would take centuries for the investment to earn back its cost purely through profits. This is not rational investing. It's a gamble based on the hope that someone else will pay an even higher price tomorrow. Palantir is only the tip of the iceberg. Burry's $186 million position against Nvidia, which extends into 2027, signals that he believes the AI chip sector as a whole is suffering from the same distortions that fueled past bubbles. Nvidia alone has a market capitalization surpassing $3 trillion, exceeding the entire stock market of some nations. Burry has accused technology companies of manipulating depreciation schedules on AI infrastructure to inflate earnings artificially. Essentially, billions spent on computer hardware are being spread across unrealistically long periods, making quarterly profits appear higher than they truly are. If accurate, this means the astronomical valuations assigned to these companies are grounded in inflated numbers rather than genuine profitability, a scenario reminiscent of the misleading mortgage-backed securities that triggered the 2008 crisis. The parallels are striking. In 2000, companies with no revenue traded at billions of dollars because investors were enthralled by the internet. In 2007, housing prices doubled in 5 years because real estate was assumed never to decline. In 2025, AI companies are losing money hand over fist while their stock prices soar because investors are chasing the future potential narrative. Each bubble carries the familiar refrain, "This time is different." Yet the math has never lied, and today it is signaling extreme risk. The broader market conditions also mirror previous bubbles. Like the run-up to 2007, the Federal Reserve has flooded the financial system with inexpensive credit, encouraging investors to chase returns in any asset regardless of actual value. The so-called Magnificent Seven tech stocks, Apple, Microsoft, Google, Amazon, Tesla, Meta, and Nvidia, now collectively exceed $15 trillion in market capitalization, surpassing the GDP of entire nations. 7 companies representing more economic value than billions of people. This is an extraordinary level of concentration and risk. When bubbles inevitably burst, insiders always exit first. Executives sell their stock options, venture capital firms cash out, and institutional investors offload holdings while retail investors are left holding the bag. Those who recognize the pattern early, hedge funds, value investors, and disciplined traders, prepare defensively with cash, gold, government bonds, or put options against overvalued equities. These become lifelines when the market finally corrects. Meanwhile, ordinary investors, pension funds, and retirement accounts overloaded with speculative tech stocks suffer the consequences. Michael Burry's actions in 2025 echo his behavior in 2008. Then, he saw the systemic risks in the housing market before anyone else and acted decisively, generating hundreds of millions in profits while the broader public faced ruin. Today, he is issuing the same warning. By closing his fund and walking away from a market he deems mathematically irrational, he signals a profound disconnect between stock prices and economic reality. The lessons of history are clear. Brilliant investors exit when conditions become unsustainable, warn about impossible valuations, and are ignored by the masses until reality strikes. The question every investor must ask themselves now is simple: will you heed the warning, or will you be among those who learn too late that when legendary investors like Michael Burry walk away, it's not because opportunity is gone, it's because disaster is looming?